Howdy, everybody. Welcome to Liberty Call. Today is Monday, July 31st, 2023. Hope everybody's had a fantastical day and a fantastical weekend out there. Had a pretty good one here. See, we did watched some baseball, and we went hiking yesterday. That was fun. Went up to the Devil's Head Fire Watchtower, which is not too far from. Well, actually, let me bring this up on the screen here. So, where's my? There it is. All right, this is my background on my computer, but this is where I live right here, back in here somewhere. And this is where we went, right up in this spot right up here. So you had to drive all the way up to where you can get the gap in the range and then drive all the way back south. It was a nice little climb. So let me show you a picture. Here's my boy Jake. Here he is up at the top, and you can see how high up we are. And but he stayed still. He didn't run off. Anyways. All right, so did some hiking, got some exercise. I am sore as hell today. I had not done any hiking since last year when I was in New Hampshire, and it was only about a mile and a half to the summit, but from the parking lot, but it was still quite a trek. Anyways, like I said, hope everybody had a good weekend out there. And if it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, notifications, hit those buttons so that you know when we go live. All right, so let's go ahead and jump into the numbers for today. Everything slightly finished in the green. Everything had gone red earlier today. The Dow Jones was up 0.28%, 100 points, closed at 35,559. S&P 500 was up 0.15%, closed at 45,88. NASDAQ up 0.21%, closed at 14,346. The VIX was up 2.33% today. It's currently at 1364. Canada was up 0.52. Brazil was up 1.46%, and Mexico was down 0.11. Over in Europe, Germany was down 0.14. UK was down 0.07. France was up. The UK was up 0.07. France was up 0.29%. The Netherlands down 0.29%, Italy down 0.45. Spain down 0.45, Italy up 0.49, getting crossing my numbers up there. Switzerland down 0.08 and Portugal down 0.43. Russian exchanges both in the green today. The MOEX up 2.16, RTSI up 2.3. And all green in Asia. The Nikkei in Japan was up 1.34%. Australia up 0.09. New Zealand up 0.86. In China, the Shanghai was up 0.46%. The Shenzhen Component up 0.75%. China A50 up 0.27%. DJ Shanghai up 0.6%. Hang Seng up 0.72%. And the Taiwan weighted up 0.3. All right, so that was everything for trading day 7/31. So we're at the end of the 7th month of the year. Hard to believe these things just are flying by. Anyways, all right, let's jump over to the weekly economic update. Friday's surge pushed stocks solidly into positive territory last week, ignited by cooling in an inflation gauge closely tracked by the Federal Reserve. The Dow Jones advanced 0.66%. The S&P 500 was up 1.01%. NASDAQ was up 2.02%. And internationals gained 0.74%. All right, stocks pop. Stocks were flat for much of last week amid a batch of new earnings, a quarter of a percent interest rate hike, and strong economic data. After beginning with gains, stocks lost momentum following the Fed's expected rate hike announcement on Wednesday. A bounce on Thursday sparked by positive mega caps. Tech company earnings reversed after bond yields increased. Let's see here. Stocks recovered strongly Friday on the release of the Personal Consumption Expenditures Price Index, which fell to its lowest level in 2 years. Much of the market action was related to earnings results, with 44% of S&P 500 companies reporting 78% have exceeded Wall Street forecasts. Recession deferred. Well, I don't know about that. Expectations of a recession were high coming into 2023. Last week may have erased this recession narrative overhang. Second quarter gross domestic product data released last week was one big reason why. Economic activity expanded by 2.4%, which was above the forecast of 2% and represented an acceleration from the first quarter GDP of 2%. Consumer spending was a major driver of that expansion, rising 1.6%. Joining the recession deferred camp this week was Fed Chair Powell, who stated the Fed is no longer forecasting a recession. Okay, yeah, because they've been right about so much. All right, economic data this week. Tomorrow on Tuesday, we have the Institute for Supply Management Manufacturing Index and the Job Openings and Labor Turnover Survey, the JOLTS report. Wednesday, we have the ADP Employment Report. Thursday, we have jobless claims and the ISM Services Index. And Friday, we have the employment situation. Got a gaggle of companies reporting earnings this week. Today on Monday, we had Arista Networks and ON Semiconductor Corporation. Tuesday, we have AMD, Pfizer, Caterpillar, Starbucks, Merck, Prudential, and Rockwell Automation. Wednesday, we have CVS, Qualcomm, PayPal, Shopify, Albemarle Corporation, Emerson Electric, and Humana. Thursday, we have Apple Block Inc., Gilead Sciences, Amgen, Cigna Group, Occidental Petroleum, Fortinet, ConocoPhillips, Booking Holdings, and Regeneron Pharmaceuticals, and Friday, EOG Resources. All right, well, that's the weekly update. So are y'all excited? I know I am. All right, well, let's get to the market recap for today. Dow wraps up second monthly gain in July as energy jumps. The Dow Jones closed higher on Monday, concluding July with a second consecutive positive month. The index brushed off a dip in the healthcare sector as energy stocks surged, driving the overall gains. Energy stocks were boosted by Chevron's more than 3% rally after the oil major received an upgrade from Goldman Sachs, citing potential for strong growth. Climbing oil prices reaching multi-month highs also contributed to the sector's rally, driven by expectations of tighter global supply and increasing demand. However, the healthcare sector faced some challenges, with J&J witnessing a 4% decline. The company's plan to place its subsidiary, LTL Management, into bankruptcy to handle legal claims regarding talc causing cancer was rejected by a judge. You can't do that. You can't just create another company and then push all that into the other company and then, oh, it's not us. I mean, you had asbestos in baby powder for basically my whole life, and I'm shocked this hasn't come out before now. All right, where were we? Dexcom Inc., despite raising its annual revenue forecast last week, also dragged down the healthcare sector, falling 6%. CSX, the railroad company, experienced a decline of over 1% after RBC downgraded its rating, citing coal volume headwinds. The coal segment, which constitutes nearly a fifth of CSX revenues, is projected to decline by 20% in 2024, leading to potential downward earnings revisions. Salesforce was downgraded by Morgan Stanley, though losses were contained as the bank also raised its price target on the stock. Big tech companies Apple and Amazon are in the spotlight this week, with investors closely watching their earnings reports following the better than expected quarterly results from Microsoft, Meta Platforms, and Alphabet. Toy maker Hasbro received Wall Street praise, surging more than 4% after Bank of America upgraded its shares to buy from neutral. Optimism surrounds the expectation that Hasbro will deliver better than anticipated earnings. Tupperware Brands continues its impressive run, rising by 40% and marking a total gain of over 450% in July. Many attribute this surge to the meme stock craze that also drove OG meme stocks like GameStop. Overall, the Dow Jones positive performance in July was supported by the energy sector's strength, offsetting the healthcare sector's temporary setbacks. Attention remains focused on the earnings reports of major tech companies and the ongoing meme stock fever influencing certain stocks like Tupperware. All right. So seems like earnings are coming in pretty decent right now. So we'll see where things head in the second half of the year. Again, I don't have a lot of high expectations. I would not be surprised to see things completely collapse, just because all of the forward-looking data does not look good. The trailing data looks great, jobs, spending, things like that. But those are what people have done. It's what people are going to do is what I have a worry about. All right, next, gold futures back at 2,000 with biggest gain in 4 months for July. Okay. Gold experienced a volatile month, but ultimately proved favorable for its supporters as it returned to the 2,000 per ounce mark in futures trading, marking the largest gain since March. The most active December gold settled at $2,009.20 per ounce on the New York's COMEX, closing 0.5% higher on the day and recorded a 4% increase for July. However, the spot price of gold, which reflects physical trades in bullion, remained below the COMEX peak. July presented challenges for gold enthusiasts, with the precious metal nearly testing 1900 support due to a dollar rebound and renewed hawkish talk from the Federal Reserve. The central bank prioritized it bringing U.S. inflation back to its long-term target of 2% and remained data-focused in its approach. The upcoming July U.S. jobs report is seen as a significant point for the Fed to assess its rate regime's effectiveness in moderating jobs and wage growth, which plays a key role in controlling inflation. The report on non-farm payrolls for July will be closely watched, with economists forecasting growth of 200,000 versus June's 209,000. The Fed has succeeded in reducing inflation from a 4-decade high in June of 22 to 3% per annum in June of 23. But this came with significant interest rate hikes to counter their impact of the COVID-19 relief spending. The upcoming jobs report will influence market sentiment and potentially drive gold's next significant move. If Wall Street anticipates rate cuts by early 2024, gold could find support above the $2,000 level, according to analysts. The report's release is eagerly awaited to gauge gold's future trajectory. I mean, personally, I'd like to see our currency backed by gold, but, I don't really see the people in charge doing that, because then you can't inflate your way out of problems. Well, you really don't inflate your way out of problems. You delay the problems down, several years down the road by inflating the markets today or inflating the cash base, and then which all that does is push up asset prices, stocks, bonds, houses, cars, fuel. I mean, everything gets more expensive because of the increase in the money supply. And that's, like I said, I'm a big fan of sound money. So, all right, last up comes from our buddy Brian Westbury at First Trust. His article today titled, "Not All Recession Theories Make Sense." All right, Austrians and Keynesians have different views on the causes of recessions. Austrians believe that recessions are a result of government failure, while Keynesians attribute them to market failure. For instance, they look at the 2008 financial panic and see different root causes. Austrians argue that it was the government's intervention in subsidizing housing and the mark-to-market accounting rule that led to the recession. They believe that without these subsidies and accounting practices, the recession may not have occurred. Now, with the economy artificially stimulated during the COVID pandemic, some analysts are predicting an upcoming recession. The M2 money supply has declined in the past year, and the inverted yield curve, which rewards short-term cash, might limit business investment on risk-taking. Others argue that high mortgage rates, credit card rates, and auto loan rates will squeeze borrowers and lead to reduced spending in other areas, thus causing an economic slowdown. However, upon closer examination, these arguments have some flaws. The extra mortgage payments made by homeowners at higher rates don't disappear but are paid to the lender, increasing their purchasing power. Additionally, home prices aren't sharply declining, so few new homeowners are likely to face negative equity or strategic defaults. While some individuals may be affected by higher costs, their spending becomes income for others, and these factors don't align with Austrian economic forecasting. Mr. Westbury emphasizes that government policy matters significantly, and that the massive stimulus and lockdowns during the COVID pandemic, seen as some of the biggest policy mistakes in U.S. history, have consequences that must be dealt with. While forecasting during unprecedented times is challenging, he argues that this is the significant factor, not the minor ones, that will determine the occurrence of a recession. In summary, Austrians and Keynesians have divergent views on the causes of recessions. The 2008 financial panic is cited as an example of their differing perspectives, with Austrians blaming government intervention and Keynesians pointing to market failure. As the economy faces potential risks, including declining M2 money supply and increased mortgage rates, analysts are divided on the potential causes of a forthcoming recession. While some focus on high mortgage rates and others other expenses as possible triggers, the author suggests that the broader government policy decisions that will have the most substantial impact on the economy in the long run. Yeah, pretty much, government screws shit up, or pardon my French, screws things up, and then we, the citizens of this country, are the ones who have to deal with the consequences of it. Oh, well. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.